Hi, everyone. I'm Maggie McGrath, senior editor at Forbes. U.S. stocks are in the red on Thursday following President Trump's reciprocal tariff announcement. The Nasdaq, the Dow, and the S&P have all been down 3% or more in early Thursday trading. Joining us to talk about the economic impact of these tariffs and also the market reaction is Andrzej Skiba. He is the head of BlueBay U.S. fixed income at RBC Global Asset Management. Andrzej, thank you so much for joining us on what is one of the busiest days for the market of perhaps all of 2025.
It is indeed, Maggie, but pleasure to be here with you.
So let's start with where we are right now with the markets. It's just red everywhere you look and has been all morning, really, ever since the tariff announcement became official yesterday afternoon. What's your reaction to what we're seeing in public markets?
Look, investors were shocked by the extent of the tariffs, and particularly looking at some individual countries that were hit with tariffs well in excess of 20-30%, that really played with investor imagination. So we're seeing a pretty sharp response in the markets today as many ponder whether this is big enough of a hit to U.S. economy, to U.S. consumer, to start talking about recessionary risk ahead.
We'll get to that recessionary risk, but one of my questions for you is you've released commentary earlier this week saying that you've held the view since the election that Trump is serious about tariffs. And I think investors broadly shared that perspective. So what accounts for the magnitude of today's losses? Was it that the details of the tariff plan were relatively scant up until yesterday?
I think there are two factors at play here. The first one is that while many investors we spoke to over the recent months believe in tariffs being a real threat, most expected them to be piecemeal, targeting maybe specific sectors rather than entire countries, and also at rates that are lower than what was announced. Many investors we spoke to also questioned how much of an inflationary pressure we could see as a result of those piecemeal tariffs. So I think the first factor that led to such aggressive reaction is the realization that those hopes of a small tariff package, something very specific to an industry or two, were essentially naive, and the market was complacent in assuming a mild version of a trade escalation. The other reason why we think we've seen such a strong reaction is indeed because of the magnitude of tariffs on some key trade partners for the US. The fact that we're not seeing 10% tariffs, 15% tariffs, but in many cases 20% and above, that really played with investor imagination. And even though when you look at the details, they suggest that not only Canada and Mexico are exempted for now, but also quite a number of goods categories are exempted for now. Just the sheer magnitude of individual country tariffs really pushed sentiment in a negative direction.
Let's talk about those key trade partners. As you look at the long list of countries and territories that will be, according to President Trump, the recipients of these reciprocal tariffs, what are the 2, 3, or 5 that most stand out to you and or are most concerning?
Well, look, when you look at the volume of U.S. imports, two countries or blocks really stand out. The first one being European Union, the other one being China. So between those two partners, you already have around a third of our trade accounted on the import side. Canada and Mexico account for another 30%, although, as we mentioned, they were largely spared. So, when we're looking at the detail, focus is clearly on some of the largest trading partners for the US. So European Union, China, Japan, South Korea, UK, being good examples of those trading partners where tariffs placed on goods coming from those partners are material enough to move the needle for the overall tariff that we will face.
So if you were President Trump and you were to make a deal with any of the areas, blocks, or countries that you just mentioned, or if you were a leader of one of the areas, countries, or blocks that you just mentioned, who's the first phone call? What if we could fix one? What's the one that you would identify as let's make something happen here so we can lower these percentages or get rid of it entirely?
Well, thankfully, I'm not in a position of U.S. negotiators as we will try to address this situation. But I think, in terms of agreements that could be easier to be made, could be one with Europe, for example. Europe is looking to um, uh, Europe is looking to find a partnership with the U.S. in the context of its rearming. And as Europe is trying to respond to the challenges that the continent is facing, US is a partner that Europe needs. So we do believe there is a compromise to be found between EU and the US. We also absolutely believe that not just to do with Europe, but with a variety of trade partners, there will be almost like a two-track process happening right now. One being retaliation measures taken by those countries, and then looking to U.S. Trade team to respond to those. But at the same time, conversations about potential concessions, about ways to reduce the tariff burden, to actually find an agreement that lowers some of the rates that were announced yesterday. So it could be this two-track process where first you have headlines about retaliation, and that is something that we believe market will be spooked by, but then the work of finding compromise, finding ways to reduce the burden will ensue. We do believe, however, that the end state when it comes to the average level of tariffs that we will see is probably not too dramatically lower compared to what we've seen yesterday. So there's some room for improvement, but we don't think that you will see a dramatic reduction in the level of tariffs that are charged in the months ahead.
So no matter what negotiations happen going forward, we're still looking at, I believe you had put out a 10%, 10% tariffs are likely to be inflationary. We'll get to inflation. Let's go back to the piecemeal comment that you made, because we've been talking a lot about the tariffs that could affect the auto industry. But as you look at what was announced yesterday, what do you see as the economic sectors in the US that are most vulnerable right now?
So look, the market was focusing on attention on a pretty short list of sectors that are most vulnerable in the context of a trade escalation. As you correctly mentioned, auto parts were one of the clear examples, but it's not the only one. We're seeing a meaningful hit to sectors like discretionary consumer goods, where you import a lot of those goods, and those prices will be impacted by the tariffs that were announced. Similarly, within the industrial complex, quite a number of, for example, chemical products could be imported into the US. So we're seeing pressure on companies where supply chains are international in nature, and that they can be impacted quite hard by what's been announced yesterday. So there are clearly a number of sectors that have been disproportionately hit, but we also know that these sectors were pretty well telegraphed. So when we're looking at the performance of fixed income instruments from those sectors in recent months, we've already seen underperformance of those trade-sensitive sectors manifesting itself in anticipation of the announcements that we've seen yesterday. So as far as we're concerned, actually, in case of those most impacted sectors, probably most of the price adjustment has already occurred. And our attention is actually switching to other topics, like, for example, the overall strength and resiliency of the US consumer, whether that will remain in place.
Well, you fed into my next question, because I do want to go to your market commentary from yesterday, where you said that 10% tariffs are likely to be inflationary. Can you talk a little bit more about, now that we have the fuller tariff plan, what are your inflation expectations and how equipped is the U.S. consumer to handle something like this?
Yes, without a shadow of the doubt, these tariffs are likely to push inflation higher. So prior to the announcement yesterday, our base case working assumption was that the end state will be an average tariff of around 10%. And based on our analysis, that was likely to add up to 1 percentage point to headline inflation. 1 percentage point doesn't sound like a lot, but from Federal Reserve's perspective, it is a very meaningful amount that actually could make all the difference between being able to cut rates and not. So with the announcements yesterday, the average tariff that we are calculating on the back of those announcements and taking into account the exemptions that were announced as well, is somewhere in the range of 15%. So clearly higher than the number that we were looking for. And we will see whether the end state tariffs, after all the negotiation is finished, trends towards that 10% level. But if we stay around the parameters that were set yesterday, clearly that upward pressure on inflation will be even greater than the 1 percentage point that we were expecting earlier, maybe 1.5%, if not higher. So clearly, we do believe that U.S. consumers will be feeling the pinch of dealing with higher priced items, higher priced goods, and that will translate itself into overall high levels of inflation, something that we do not believe Federal Reserve can ignore.
Well, in mentioning the Federal Reserve, I'm thinking of President Trump's pressure on Fed Chair Jerome Powell to cut rates. So is this tariff announcement conflicting with his desire for lower rates? And could that conflict potentially have an effect on tariff policy as the reaction continues to unfold, in your view?
Well, Maggie, I think that's a fascinating question because right now, as you're looking at treasury markets, and we're talking about inflation moving higher, you would not expect a rally in treasury prices when this is the outlook that we are considering. Instead, we are seeing investors flocking to treasury bonds as a safe haven. And we think that is really to do with growth fears. So right now, what's foremost on investors' mind is the growth concerns for the U.S. economy. And in that environment, you really want to increase your exposure to U.S. treasuries as a way to protect your portfolios from that growth negative pressure. At the same time, once we believe there will be clarity over the coming weeks about the extent of the tariffs, the end state that we're dealing with, I think investors will start asking questions about the inflationary impact, and that could lead to a pressure on treasury prices, upward yield pressure, as investors realize that Federal Reserve might not be in a position to cut rates even in the face of a slowing economy. But for the time being, all of the focus is on growth. And that is the reason why treasuries are rallying rather than investors pondering what kind of inflationary impact we will see over the months to come.
So we're seeing a flight to safety to treasuries. Meanwhile, I believe you're getting questions from clients about, I know it's impossible to fully time the market, but I think they want to know, is the pain that we're seeing today, all that red, is this the worst it will be? Or will the market continue to go down? And is there a better buying opportunity for equities in the future?
Look, when we are considering investor behavior in recent years, buy the dip mentality has been so strongly ingrained in investor psyche. And we are really curious to see whether the same attitude will kick in short order again. We think that we might have to wait a little bit for that, however. The simple reason being is we're not done with negative headlines. After the announcements yesterday, we expect to see all the retaliation announcements from U.S. Trade partners. That is likely to add to volatility. Then you will see a response from the U.S. to those retaliation announcements, which further could exacerbate fears within the market. So we think for the time being, it's probably too early to buy the dip. There could be more volatility ahead. Having said that, when we're looking at the range of risk indicators, we're close to hitting peak bearishness in a number of segments of the market. So once policy clarity is gained, once we have better information about what the end state of this trade escalation is likely to look like, we do believe there will be some investors who will be willing to step into the void, but we might have to wait a little bit longer for that. And those investors that are likely to step in are the ones that do not believe in recession as a base case scenario for the US. We are definitely in that camp. This is not our base case assumption, but clearly there's also a lot of investors who are very worried about recessionary risk ahead.
You fed into my next question. I was about to lay out a math problem where bearish markets, inflationary economic conditions, are we headed towards a recession? But you just said that is not your base case. So what is your base case for the US economy right now?
Look, we absolutely assume slower growth as a result of all that is happening around us. It's inevitable that this will have negative impact on US growth ahead. However, we believe that it is still likely that we settle around 1.5% growth in the US. There is some downside risk to that number, but from 1.5%, even with some downside, there's quite a long way to negative readings. And to us, the key question is really about the health of the US consumer, because so far, US consumer has proved itself to be resilient to the extent that very few investors expected. Two key factors really helped US consumers. First, the fact that the labor market's been pretty strong. We have not seen any meaningful pickup in layoffs within the US market, away from all the drama to do with Doge. We have not really seen any material negative shift in the labor market. And the other thing that helped is so many consumers refinanced mortgages when the rates were around 3%. So they're not feeling the pinch from higher level of interest rates. If we start seeing layoffs increasing in a material way, to us, that would be a reason to worry, and that would be a reason to start discussing recession as a more probable scenario. But for the time being, we're just reflecting on the fact that when we're looking at sentiment data, it's been quite wobbly. It's been quite weak in recent weeks. However, when you look at hard data, it has been pretty robust. So we're not seeing the evidence yet in US economy of the consumer weakening aggressively. And for as long as that is the case, we do not believe a recession will happen in the same way as recession did not happen in 2022 when so many investors were expecting that outcome.
That's a good point. I spoke to a labor economist last week who talked about how frozen the labor market is now. A lot of companies are sitting on cash and not hiring, and it's been a big wait and see game. When do you think the wait and see game will end? It sounds like you guys are also waiting and seeing. How much longer are we just sitting tight?
Well, look, we hope that it's not too long, because you have two key factors that investors were focused on over the coming weeks. The first one was the resolution of this very trade escalation, this trade war that we are witnessing right here, right now. But the other point was to do with the budget and seeing whether this administration, Trump administration, will have an ability to cut taxes, push through the budget, and have an agreement in Congress around that. So when it comes to the trade war, we do think that over the coming weeks, probably by the end of April, maybe early May, we should have a good idea about what the end state is, something that market can coalesce around, have a bit more clarity over. And then we do believe it's not going to be too much of a wait to have answers to do with the US budget as well. And I think once you have those in place, Once you know what's the level of tariffs, what's the level of taxes, what kind of incentives for capex and U.S. investments investors and corporations will have, I think it will be easier to make decisions. Right now, everyone is trying to deal with this fog of uncertainty. And as you rightly mentioned, that means deferring investment decisions. That means deferring choices that you might have hoped to make earlier this year. Instead, you might have to wait a little bit longer. But we do not believe that wait will be till, let's say, later this year. We're probably going to have a lot of clarity by the time the summer comes.
So the markets are in the red. Clarity might come by the time summer comes, and RBC is not yet predicting a recession. I do want to close with a different version of the questions I've been asking. We've been talking about the negative ramifications of this tariff announcement. Again, markets are down. People are worried about inflation impact. Is there any economic benefit to what President Trump announced yesterday? Is there a method to the madness that could benefit the U.S. economy or equity markets or fixed income or anything we've been talking about today?
Well, look, there's always a silver lining to events like that, and there's a couple of those that we can highlight. The first one is the fact that dollar is weaker as a result. That will help U.S. Exporters, so that's seen as a positive. The other thing that also over time will help U.S. economy is re-onshoring of production to the U.S. There's a very clear message from the Trump administration that if you produce in the U.S., you will not be faced with any of those tariffs. So clearly there are some trade partners, some corporate investors who will decide to move production facilities to the U.S. We've seen already quite a few of those announcements earlier in the year, and that clearly would be positive for the U.S. economy. So I would say that is a second silver lining. And the third one is the fact that as part of negotiations, as part of concessions that might be found, some of the external trade barriers that were preventing access for U.S. goods to global markets might be removed. That would be one of the easiest ways to reduce tariffs going forward, and would have a lasting positive impact for the U.S. So it feels quite dark. It feels really challenging right now when you're looking at market trading levels. But we do believe that there are silver linings for the U.S. economy as the dust settles and we have clarity over what policy looks like ahead.
Andrzej Skiba, head of BlueBay U.S. fixed income at RBC Global Asset Management. Thank you so much for sitting down with Forbes. We really appreciate your time and your insight today.
It's been my pleasure. Thank you.